Good Saturday morning to everybody, and welcome to Legal Notes with Mary Ann Sharon and Ned Barron. I'm Gary Byron. They are from Charter Oak Law. We are sans Mary Ann Sharon this morning, but we still have Ned Barron. Good morning, Ned. How are you?
I'm fantastic, Gary. How you doing?
Not doing too shabby. How's business, too?
Really busy.
So let's talk this morning a little about state and federal estate taxes. If I'm not mistaken, Connecticut is one of 11 states with an estate tax, right?
That's true. You know, now that Mary Ann's not here, I decided we'll do the boring technical stuff, right?
Just for you, right? Funny how that happened.
Yeah, it's funny that you know, they say you can't take it with you. Well, you can't, but the state is going to try and take what they can. And so
there's a shocker.
One of the things that when I have meetings with clients regarding estate planning that I'm always looking out for as an estate planning attorney is what is the possibility of there being a taxable estate at the death of either, if we have a married couple, at the death of the first spouse or at the death of the surviving spouse. And for most married couples, because there is an unlimited amount of money that you can leave to your surviving spouse. So, for example, if I had $1 billion and I was married and I died, I could leave my spouse $1 billion and there would be no state or federal estate taxes. But now that surviving spouse, if they don't get remarried, and most surviving spouses don't get remarried, now there's a big tax problem because at their death, they're going to have $1 billion and no spouse to have that unlimited deduction. And that $1 billion is going to get taxed in Connecticut for federal and Connecticut estate tax purposes.
Could it go to children?
Not free of estate taxes. That unlimited deduction only applies to a surviving spouse.
Okay.
So when it comes to, or I'm saying unlimited exemption, when it comes to leaving money to anybody else other than a spouse, we all have a federal and estate tax exemption. The exemption being the amount of money that we can leave to a non-spouse free of estate taxes.
Is that what was it? 10 grand?
10 grand? Oh, I think you're talking about the gift tax.
Oh, maybe that was the gift tax.
Yeah, we'll get to that.
All right, okay.
We'll get to that. Just as a little teaser, that in Connecticut and for federal purposes, that there is so Connecticut is the only state in the country that also has a gift tax.
Yes, that's what I was mistaking it with.
And I think it's modeled after the federal, estate and gift tax. So it's a unified tax, and meaning that the exemption at death, the amount of money that you can give away at death free of tax, also applies to gifts that you make during your lifetime. So you have a limit. The exemption is the amount of money that you can leave at your death free of taxes. Mm-hmm. But you can also decide to give that away during your lifetime. And whatever you give away during your lifetime that is a taxable gift would then count towards the calculation of your estate for estate tax purposes at your death.
Okay.
Meaning, we'll get into the numbers, but let's just put it this way: if the estate tax exemption was $100, and which means I can give $100 away free of tax at my death, I can also give that $100 away during my lifetime, but I'm using up what I can give up.
I see what you're saying.
Death. So
yes.
if I can either give it $50 during my life, and then I can pass $50 at my death free of estate tax. So, but we'll get more into the numbers because.
So what is an estate tax? When is an estate tax imposed on an estate? Let me ask it that way.
Yeah. So as I said before, we all have an exemption. So a number of dollars that we can give away free of tax at our death or through gifts. And right now, the federal exemption for 2021 is $11.7 million. So that means that if at my death, if I have $11.7 million and I didn't give away any taxable gifts during my lifetime, I can leave $11.7 million to my kids, to my friends, to my siblings, anybody, right? Mm-hmm. And it would not be, there would be no estate tax due on that $11.7 million. In Connecticut, that the Connecticut exemption for 2021 is $7.1 million. So again, I could leave $7.1 million to a non-spouse free of estate tax. And that's great. I mean, for most of us, we don't have to worry about paying estate taxes. Although we'll talk about in a minute why I think more of us are going to have to start worrying about it, but that's going to involve changes in the laws that I think are coming down the pike. Mm-hmm. But now something interesting, though, about the Connecticut exemption is that the Connecticut exemption is increasing over the next few years. So in 2022, the Connecticut exemption is going up to $9.1 million. And in 2023, the Connecticut exemption is going to match the federal, meaning it'll be linked to whatever the federal exemption is. So the federal exemption is, right now $11.7 million. That's indexed for inflation, and but assuming that, let's just say there was no inflation between now and 2023, which, given what's going on, I highly doubt it.
Yeah.
Right. But if nothing changes, then the Connecticut exemption will be $11.7 million in 2023. And if nothing changes, that will stay the same. However, because now Connecticut will be linked to the federal, we're going to follow whatever happens with the federal exemption. And right now, in 2025, the federal law that's on the books that increased the federal exemption from $5.6 million to $11.2 million a few years ago is going to sunset, meaning that law
is going to go
away. It's going to go away, and that the estate tax exemption of $5.6 million for federal purposes is going to be in play for 2026. So for 2026 going forward, it's going to be $5.6 million. If that's the case, that means the Connecticut exemption in 2026, if nothing is done, there are no laws were changed for federal estate purposes for estate taxes, then Connecticut exemption is going to go to $5.6 million.
Because it mirrors the feds.
Right. Yeah.
Wow. So what is included in the gross estate for estate tax calculation?
Well, in a word, everything.
Jeez.
Well, so some of the things that are included in the calculation of the estate tax, the gross estate for estate tax purposes, is let's just say, for the sake of argument, that I'm single and at my death, there's going to be a snapshot taken of all of my assets and the value of my assets that I owned as of my date of death. So that would include bank accounts, investment accounts. It would include the value of retirement accounts, so 401ks, any cash, for pension, annuities, your real estate, your cars, if you had, an expensive coin collection or antiques and all that could be, appraised and then we could find out what that value is. So basically it's all of the assets that you own, plus if you had any life insurance on your life, whatever the payout was on that life insurance. So if I had $1 million policy that was paid out to my kids, let's say, that $1 million is going to be included in the calculation of my estate tax included in my gross estate for the calculation of estate taxes. To
be clear, you're saying your life insurance policy.
Yes. The
value of your life
the
insurance.
Payout.
Right, not what you paid for it, but what your payout is.
Right, yeah, right. Okay. Right. Yeah. So basically it's everything.
Wow.
Everything that you had an ownership interest in is going to be used in that calculation.
Wow. Talk about something I mentioned a little while ago, if you don't mind. The gift tax. I brought that up because I had it confused at that $10,000 mark. If you
sure.
Remember. So can you just kind of go into that a little bit, or
yep,
if you don't mind?
Yeah. So as we said before, that the gift and estate taxes are unified for federal and Connecticut purposes.
Yep.
So you only get a certain amount that you can use up, so to speak. That exemption, right? In this year, let's say the $7.1 million for Connecticut purposes, that you can only use it as a gift or give it away at death, but you can't do both. You know what I mean? That once you use up the $7.1 million in gifts, let's say, then you won't have any exemption left over at your death. There is the key phrase is taxable gift, though. And a taxable gift is any gift that would be considered taxable according to the code. And there is an annual gift tax exclusion that each of us has, that we are able to give $15,000 free of gift tax to anybody we want and as many people as we want. So that gift tax, right? So I can give $15,000 to my son. I can give in 2021. I can give $15,000 to my son. I can give $15,000 to my daughter. I can give $15,000 to my brother. Another 15 to my sister. I can give all those, and those are not taxable gifts.
All right, now let's say you want to exceed that $15,000 threshold.
Right.
Let's say you want to give everybody $25,000.
So what that means is that the first $15,000 of that gift is
not taxable.
Right, is not taxable, but the $10,000, right, to get to the 25 is taxable. And in effect, and the interesting thing is that when you do make taxable gifts, you are required to file a gift tax return for Connecticut and federal purposes. So let's just use round numbers. Let's say that I decided I was going to give 10 gifts of $25,000. Right. So 10 different people, I'm going to give $25,000. Now we know that the first $15,000 of each of those
not taxable.
So it's $10,000 is the balance times 10. It's $100,000. Right. So what I have to do at the end of the year is I have to file a gift tax return showing that I made $100,000 in taxable gifts. Now, I don't have to pay a gift tax on that because what I can do is reduce my exemption. So we know that in this year I have a $7.1 million exemption, right? So $7,100,000. And if I made $100,000 of taxable gifts, that's going to reduce my $7.1 million to $7 million. So so because I'm using up that $100,000 of my exemption, I don't have to pay tax on it. You understand?
Yeah. So then you're not getting taxed on it then.
No, it is a taxable gift, but you're using part of your exemption to.
So you're exempt from it.
To offset it, right? Yes, you're exempt, but you have now reduced the amount of money that you can further give as gifts or leave at your death free of estate tax
because you're up to 7.1.
Right. So under that example that we just gave with the $100,000 in taxable gifts, now my exemption went from $7.1 million. I used up $100,000
to just $7.
Right. So now it's $7 million. And, if every year I give away, another $100,000 in taxable gifts, it's just going to keep chipping away at that original $7.1 million exemption. But again, I'm not going to have to write a check for a gift tax until I've used up that exemption.
That was a good explanation, actually. I think for me, that clarified a lot. I think a lot of people aren't even aware of that exemption. You've mentioned the 7.1 in Connecticut and the 11.7 federally.
Right. Yeah. Well, so for most of us, we don't have to worry about it, right? I mean, there aren't that many people
who have
$7.1 million that were worrying about it. However, as I said to you before, that the federal exemption is going back. Is if nothing is done, it's going to sunset and it's going to go back to $5.6 million.
But even that's pretty high, no?
It is. However, we have a little bit of a problem on the horizon, and that is that we have a Democrat-controlled Congress. Mm-hmm. We also have Democrat-controlled White House, and during the Democratic primary for president, mm-hmm. there were several candidates who were running for president on the Democrat side who had said that if they are elected president, they're going to reduce the federal estate tax exemption. And probably one of the loudest ones who talked about that was Amy Klobuchar, who is a sitting senator, and she wanted to reduce the federal estate tax exemption to $2 million, which that
would affect a lot of people.
It would affect a ton of people because, and one of the main reasons why is because
health insurance. I mean, the life insurance policy, I would imagine.
Well,
too.
Sure, life insurance,
that's
but
being
also
factored in,
right? But retirement accounts. Because now we're basically self-funding our retirements with 401ks and IRAs and all that. That it's not uncommon for someone to have a $2 million retirement account or a married couple to have a combined $2 million. And when one spouse dies and the survivor, ends up with all the assets, now when they die, they could have over $2 million. And so I think it is highly likely that, and President Biden has said, he is definitely going to change the estate tax laws. And so I think that it's highly likely that it's going to be reduced. And I think $2 million is probably the number that we're looking at. Hopefully I'm going to be pleasantly surprised and see a higher number. But if that is the case, then that means that the federal will drop to $2 million. If Connecticut doesn't change their estate tax laws, Connecticut will drop to $2 million. And that also includes, while we're on the subject of gifts, that means that unified gift and estate tax exemption will be now $2 million.
Folks, you're listening to Legal Notes with Ned Barron, also Mary Ann Sharon, who could not be with us this morning. They're from Charter Oak Law Group. I'm Gary Byron. All right, so that's the gift tax, and I really thank you for articulating that so eloquently. If you can, go into estate tax.
Sure. Well, as we've been talking about so far, that we all have an estate tax exemption. So at our death, that there's a snapshot that's going to be taken of what the value of our estate is. Including all the assets that we already talked about. Now, the important thing that we haven't talked about yet are what are the rates, right? So if my exemption is $11.7 million for federal purposes, then anything over that at my death is going to be subject to estate taxes for federal purposes. And if I die in 2021, anything over $7.1 million is going to be taxed for Connecticut purposes. Yeah. So the federal estate tax rate, meaning the tax that's going to be imposed on the amounts over that $7.1 million, it's a progressive tax rate, starts at 18%, and it increases to 30% for the first $1 million.
Oh, my goodness.
And then
it's going to get worse.
Then after that first $1 million, it's a flat 40%.
Ouch!
So if you think about what we were talking about with if the estate tax exemption goes back to $2 million, and you have a couple, 40%. Let's say you have like $3 million is the debt is the estate that that $1 million after that first two is going to be taxed incrementally between or progressively between 18 and 30%. So the Connecticut estate tax rate for 2021 is the rate also is kind of progressive, and it is between 10.8% and 12%. So if you think about it, and so in starting 2023, the Connecticut estate tax rate, it becomes flat 12%. So if you think about it, Connecticut and federal are going to be unified, and let's just say that it does go back to $2 million. Anything that you die owning in Connecticut over $2 million is going to be taxed 12% at Connecticut and possibly 40% for federal, for a total of 52%.
Oh.
Yeah.
I can't afford to be a Democrat if I wanted to. I can't. It's too expensive to be one. It never used to be like that, neither.
Yeah. One caveat that I do want to say is that Connecticut does cap the amount of estate tax that would be payable to the state. Mm-hmm. So for everyone out there who might be concerned that they're going to end up paying way too much in estate tax, the cap in Connecticut is $15 million, which is the Connecticut tax that you would pay on $129 million.
Yeah. Right. Well, so I don't know too many people with that. What else does Connecticut hit you with after you're dead?
Well,
dare I ask?
So, we've talked about, estate and gift taxes, but Connecticut does also have something called a probate fee, which many people don't really realize that that fee would apply whether you have a probate estate or not. So one of the things that, as an estate planning attorney, that a lot of my clients want to do is to avoid probate at their death. Mm-hmm. And we have ways of doing that, such as at creating revocable living trusts. And as long as the assets that would otherwise be probate assets were titled in the name of that revocable living trust, you can bypass probate. However, if somebody dies owning an interest in real estate in the state of Connecticut, whether or not that real estate has to go through probate, the state of Connecticut gets an automatic lien on that property for estate taxes. And the only way to get that lien released is to file an estate tax return. Now, the vast majority of estate tax returns in Connecticut are non-taxable estate tax returns, and those are filed with the probate court that has jurisdiction over the residence of where the person who died lived. And so when that estate tax return is filed, non-taxable estate tax return is filed with the probate court, even though that person's estate has no other business with the probate court, there is a fee that is calculated based on the gross value for estate tax.
Is that fair? Is that right? There's something about that. You were explaining that to me earlier off the air, and I really take issue with that. So you're still paying a probate fee, even if you're not utilizing the probate court.
Yeah, it was something I think that the legislature put in place as a way to generate.
You got to find out what year, and I got to find out which one of my former colleagues voted in support of that. That's
so they did it as a way to generate revenue for the probate courts, and there's a long history behind that, which I didn't bone up on prior to this interview for that, but the bottom line is that the probate courts have. The legislature has said that they need to be self-supporting, which is really interesting because the Superior Court's not self-supporting. They don't support themselves through the fees, that they charge for services, but the probate courts are. Why that happened is a long story, but the bottom line is that in a way to have the probate courts to be self-sufficient, that they needed to generate revenues. And so you could end up paying a probate court fee. Now, just to give you a really quick rundown.
Really quick.
Those fees aren't huge. On a $100,000 gross estate, it's $465.
Okay.
On a $500,000 estate, it's $1,865. On $1 million estate, it's $3,115. And then you just keep going up to a $3 million estate is $10,615. The maximum fee that could be payable is $40,000, and that would be the fee that would be generated from a gross estate valued at over $8.8 million.
And Ned, people will say, well, that's a reasonable, in relation to the amount, it's a reasonable fee, but it's still a fee that shouldn't even be paid because it's not being utilized. So how do we avoid these taxes and fees?
Well, my snarky response is move. But,
yeah, I'll bet.
It's
a good answer.
It's tough. I mean,
sad answer, actually. Yeah.
Certainly something for another.
Oh boy.
another episode, so to speak.
All right. Folks, if you've got questions when it comes to estate tax, yikes, gift taxes, so on and so forth, things we discussed this morning, I strongly, strongly recommend you to contact Ned Barron. You can do that very easily by calling 860-570-1229. That is the phone number for Charter Oak Law Group. They've got locations in Bloomfield, Danbury, Norfolk. Again, I'll give you the phone number, 860-570-1229. I would start with their website, though, and it's simple, very easy, www.charteroaklaw.com. Once again, charteroaklaw.com. And by the way, if you've got a question that you'd like to have answered on these very airwaves, maybe as soon as even next week, simply email us at legalnotes@charteroaklaw.com. I'll repeat that, legalnotes@charteroaklaw.com. For the absent Mary Ann Sharon, Ned Barron with us this morning, I'm Gary Byron. Keep Charter Oak Law in your thoughts for all things having to do with conservatorships as well as estate planning and even these gift taxes. Oh, my goodness. I'm beside myself. I'm Gary Byron. Thank you so much for listening to Charter Oak Law Legal Notes. Until next Saturday morning, have a good one, everybody. So long.